welcome to another segment of NeuGroup Insights interview. I'm Joseph Neu, the founder and CEO of NeuGroup, and I'm joined again today by Scott Bilter, who's co-founder and CFO of Atlas Risk Advisory. You know, one of the things that NeuGroup likes to think about is the future and trying to bring the future forward. What do you see as the future of FX management, and how will tools like AtlasFX change in response to that?
Yeah, well, certainly a lot of things in FX can go in waves. And other than sort of the shock that we had, at the beginning of COVID a few years ago, it's been a pretty calm FX environment up until now, again, these last few months. So I think there's going to be some things that, used to be getting a lot of attention that will be again. A lot of that could be 4-point costs, a lot of that. The more things change, the more they stay the same in that regard. But I also think that this is most likely the beginning of kind of a multi-year commodity bull market, which is always the least popular bull market. A few companies in certain industries are going to benefit, but for the most part, it's an expense and a headache for a lot of other companies. So commodity exposures, I think, are going to be a bigger deal for more companies now, and there's often not a certain group that's tasked with that. It might be in treasury, it might be in procurement. We have some folks that I think are probably going to get that responsibility that don't know it yet. And for some of our customers, we are combining commodity and FX risk and kind of can show that in a whole portfolio approach, which can make sense where you have currencies that are, you've heard the term commodity currencies, and there's certainly some sticky correlations between the movement of certain commodities and certain currencies, which makes sense given their economies, if they're very commodity dependent. So looking at that in total makes a lot of sense. And you can have some companies that are hedging 15 currencies, but if they look at their top 2 or 3 commodity exposures that they're not hedging, those would all be well within the top 10 of their risks. So it could make sense to kind of combine that and look at that whole portfolio. So I do see that as likely being a direction that more companies are going to go to. And really just, I think overall as well, FX isn't just a treasury problem, as we've talked about. It's, FP&A and accounting. Certainly tax can impact a lot with FX, and there's needs to have, all the business folks that are getting allocated gains loss, or just the need to have it understood well within the whole company. So really just the flexible platform and total FX visibility platform, I think, is really the direction that things are going to go. I think the future is really, being able to deal with things flexibly and quickly and having just complete visibility to all your data.
Let's talk, Scott, about the importance of AtlasFX being built on top of OLAP technology. How does this give the user a better opportunity to build out their own analytics and BI tools on top of AtlasFX, and also integrate reports and dashboards with data from some non-FX related sources?
Great question. And so the OLAP, or online analytical processing, it's really the right technology for the problem, or any multi-dimensional problem. And certainly the problem of understanding FX risk is very multidimensional. It's the intersection of a lot of different data points, and you need to be able to really interrogate that data in a flexible way, an intelligent way, and not just saying, all right, I need the intersection of all these points, but in some cases dealing with corner cases with our customers. We find a lot that, all right, it's this data, but it's this subset of this, or it's this part of that data that we want to get out, and we need to filter it in some logical way that's very easy with that technology. So really, it's a huge advantage using that for us. And then in terms of just the flexibility, we have our own visualization platform, but other folks often want to make sure that anything is easily working with other technologies. We create all the APIs needed as just part of our standard process and workflow with everyone. We know that that's absolutely crucial. That we always are scratching our heads when we hear about other vendors that sort of don't play well in the sandbox with everyone else, and they're not going to deal with these guys because they're competing here and there, and it's just doesn't make sense. So we really want to create the best, a sticky solution for our customers, solve all the workflow that we can, automate absolutely anything that can be automated. So it's the right technology to make that happen.
So, it seems like one of the big advantages of having all this data available is that you can run AI algorithms and use AI modeling in your FX risk management. How do you see this evolving going forward?
Yeah, I mean, AI has been a hot topic for a while, but I don't think we're quite ready to remove the human element from risk management yet from FX. There, especially if you're talking about something like forecasting the balance sheet. There's certain items that can lend themselves well to modeling, or they may not get forecasted, and so we will sometimes have a hybrid approach of we'll model certain things based on the same period the previous year, or look at some growth rates and look at some actuals and model things that way. And then other larger items may still need to get that human touch. You don't want to have anything that is necessarily going to react based on data that might go on the balance sheet incorrectly, and that does happen.
So interesting about AI, but I wanted to think about kind of the larger picture of changes that are going on and how Treasury teams operate in the post COVID environment. And with that, Scott, maybe you can comment on, do you think centralized or decentralized Treasury teams are dealing better with the new environment that we find ourselves in?
Yeah, no, good question. I think post COVID, there's certainly been a lot of shocks to the system. A lot of folks are dealing with forecast deviation that, in some cases, made cash flow hedges that had to be, de-designated and lose the hedge accounting for certain things, and we've helped folks, deal with that. And overall, I do think that centralized treasuries are better suited than decentralized. You see this a lot, certainly on the trading side. I've talked to some companies that kind of let anyone do anything and request anything at any time and handle it in different regions. And then we look at the whole composite situation. It's like, wow, that's a lot of inefficiencies going on. I'm sure the banks love it, but there's some extra trading going in opposite direction, buying the currency this day, selling it the next day, and a very inefficient handoff or inefficient sort of netting of exposures. So I do think that an advantage on the centralized treasury is definitely the case.
Scott, really a pleasure speaking with you. I thank you for your time and look forward to further opportunities to collaborate.
Yep, absolutely. I look forward to always hearing back from our clients who attend your peer groups and all the great things that happen there. So thank you very much.